April 13th. According to reports from multiple media outlets, the U.S. Customs and Border Protection quietly revised the tariff schedule on the evening of the 11th local time. It exempted the import tax rates for electronic products and components such as smartphones and computers, which are not affected by the previously announced reciprocal tariffs, and no specific countries were designated. That is to say, as long as the goods are on the exemption list, all countries and regions can enjoy this exemption, including China. There are approximately 20 types of these products, including smartphones, laptops, hard drives, CPUs, monitors, memory chips, and some semiconductor manufacturing equipment. In recent times, from the Blitz-style extreme taxation to the postponement of tariffs and the introduction of an exemption list, it seems to have that familiar flavor. However, due to Trump's repeated and chaotic tariff policies towards China recently, let's first make a simple summary. At the end of February 2025, the Trump administration first imposed a 20% punitive tariff on China under the pretext of fentanyl. On April 2nd, Trump announced the implementation of a new round of tariff policies, including a 10% general tariff on all countries and regions, and reciprocal tariffs on 60 countries and regions with different tax rates for different regions. The tax rate for China was set at 34%. After that, China counteracted by also imposing a 34% tariff on the United States. Trump retaliated, and the situation escalated in a spiral. The final result was that the United States imposed a 125% reciprocal tariff on China, plus the previously imposed 20% fentanyl tariff, totaling 145%. China, in turn, continuously countered by imposing a 125% tariff on the United States. On April 9th, Trump announced that the reciprocal tariffs on other countries and regions would be postponed for 90 days, but the 10% general tariff would be retained. At the same time, all tariffs on China were retained, specifically targeting China. Recently, on April 12th, the Trump administration announced the exemption of reciprocal tariffs on all electronic products. For Chinese electronic products, this means that the 20% base tariff is retained, but the additional 125% reciprocal tariff is no longer required. According to China Customs data, for the products on the exemption list in 2024, China's export value to the United States was approximately $96.4 billion, accounting for about 18% of the total exports to the United States, which are core products of China's exports to the US. According to US data, the total import value of the exempted electronic products from China is approximately $100 billion, accounting for 23% of the total US imports from China. The United States imported goods worth $385.7 billion from the global list, accounting for 12% of its total commodity imports. According to the latest exemption codes announced by the White House, items from computers to monitors are all newly added. This may reflect the pressure from within the United States, such as the power of corporate lobbying and capital, or concerns about the impact on domestic consumption. Since the United States is highly dependent on China for these products and it is difficult to find alternative solutions in the short term, raising tariffs will only lead to one result. A significant portion of the costs will inevitably be passed on to American consumers, thus creating a large inflationary impact and bringing political pressure to the Trump administration. After all, Trump came to power under the banner of reducing inflation, but after taking office, he has hardly taken any effective measures to lower prices. Instead, his main tariff policy has greatly increased inflation expectations. Therefore, the exemption of these important electronic products this time, in the current public opinion environment, is naturally regarded as evidence of Trump's further concession. But has Trump really changed his stance? After being beaten by reality in the past 2 months, many people will not easily draw such a conclusion. We can see that the exemption of products does not mean a complete cancellation of tariffs, and the tariff alarm has not been lifted. Firstly, since the exemption only applies to the 125% reciprocal tariff, for China, the 20% increase imposed in February and March this year still remains. Moreover, the exemption application needs to comply with complex clauses such as the harmonized tariff schedule and full-scale sanctions can be restarted at any time under the pretext of national security. Combined with the possible additional tariffs on industries such as semiconductor chips in the future, the puzzle of Trump's tariffs is gradually becoming clear. Since the implementation of the reciprocal tariffs on April 2nd, through a series of actions by Trump and the White House, we can see that the main lines of the tariffs are starting to take shape. The 10% base tax rate will not be cancelled even with a 90-day postponement, which may be the bottom line for tariff revenue. It is difficult for most economies to cancel it through negotiation. The part of the reciprocal tariff above 10% highlights a chip for exchange, ranging from importing US goods and making investments in the US to forming a united front on issues such as increasing military spending and geopolitical policies. The negotiations are not limited to economic and trade aspects. For the industry-specific tariffs on key industries, from the earlier steel, aluminum, and automobiles to the possible upcoming tariffs on pharmaceuticals, semiconductors, etc., the tariffs in these areas will not be low and will be even more difficult to negotiate, because the bargaining chip is the return of the industrial chain. Therefore, different industries and products have different situations. Today, the United States may no longer have the conditions or the will to bring back industries with lower added values such as toys, clothing, shoes, hats, and plastic products to its domestic market. We can observe that whenever Trump administration officials promote something abroad, the industries they always mention are high-value-added manufacturing industries such as automobiles, semiconductors, and electronic products. No one has ever mentioned toys, clothing, shoes, or hats. Most people agree that if the industrial chain is to be brought back, tariffs may be one of the necessary conditions. Having tariffs does not necessarily guarantee success, but without tariffs, it is almost impossible. Therefore, the signal of exemption does not mean a shift in direction, nor can it avoid reversals. Trump is likely to continue taking actions until there is real communication between China and the United States. Looking at the domestic stock market, the three major indices of shares all declined last week. Among them, the Chinext index dropped sharply by 6.73%. By industry, sectors such as agriculture, retail, and precious metals rose at the forefront, while sectors such as petrochemicals, leisure goods, and construction machinery declined significantly. The major indices first fell and then rose, and the average share price of all the shares decreased by 4.94%. The profit-making effect in the market was average. This week, the market is expected to receive positive news, especially for the consumer electronics sector, which should experience a collective rebound. However, a situation of opening high and closing low cannot be ruled out, because from this incident of reciprocal tariffs, many investors may realize that the consumer electronics industry is still in the hands of the Americans. Even if the reciprocal tariffs are not ultimately imposed and the fundamentals of the consumer electronics industry are not damaged, the investment certainty of the industry will permanently decline, and the valuation center of the industry will face a downward adjustment. Then, the funds that previously bottom-fished the stocks will take profits while the stock prices soar, and the funds that were previously trapped may also cut their losses while the stock prices rebound. At the same time, industries such as agriculture and animal husbandry will face the pressure of correction. In fact, there have been no major changes in the fundamentals of agriculture and animal husbandry recently. Even if China does not import US agricultural products, in order to stabilize domestic prices and ensure people's livelihoods, it will transfer the import share to South American countries such as Brazil and Argentina. Industries such as agriculture and animal husbandry are more being speculated as a concept theme for tariff counterattacks. From the perspective of the broader market, currently, the index around 3,000 points has the support of the national team. However, in the short term, there will still be great pressure to break through the 3,300-point mark. Last week, the trend of the US stock market was completely related to the tariffs, and its rise and fall depended entirely on Trump's attitude. However, when the US stock market rebounded significantly, the performance of US Treasury bonds and the US dollar was not good. In the strange market where both US Treasury bonds and the US dollar fell sharply, currencies such as the Japanese yen, Swiss franc, and euro performed strongly. Especially from the perspective of capital flows, global funds flowed to Japan, but the Japanese stock market still declined. This indicates that after the funds flowed back to Japan, they did not buy Japanese assets. So what did they go to Japan for? It is possible that they were repaying the cheap loans they borrowed from Japan in advance. The world is currently deleveraging. Regarding the RMB last week, although there has not been much discussion recently, quietly, the exchange rate of the RMB once reached a new low. On April 8th and 9th, the offshore RMB exchange rate continuously broke through 7.4, dropping more than 1,200 points in 2 days. The weakening of the RMB occurred against the backdrop of a not strong US dollar index. Such a change is considered by many people to be a new attitude of the People's Bank of China towards the RMB exchange rate. According to media reports such as U.S Finance, in order to offset the impact of trade, the People's Bank of China seems to be gradually relaxing its tolerance for the RMB exchange rate. On April 8th, the central bank set the central parity rate of the RMB at 7.2038, the weakest level since September last year. This is the first time that the central parity rate has broken through 7.2 since Trump was elected President of the United States in November last year. This level is regarded by investors as the soft red line of the official attitude towards managing the currency. So where will the RMB go? Currently, institutional expectations are very confused. Wells Fargo predicts that the RMB may depreciate by up to 15% within 2 months, while Wall Street investment bank Jefferies predicts a possible depreciation of 30%. However, some institutions also believe that the depreciation range of the RMB will not be too large. For example, Macquarie Group believes that the possibility of the RMB depreciating by more than 10% significantly is not high, because in addition to China's preference for exchange rate stability, it also hopes to be regarded as a stabilizing force in the world during this turbulent period. Moreover, for global trade, the excessive depreciation of the currency of the largest trading country is not helpful in alleviating trade tensions, but may instead cause unnecessary trouble. Unless the contradictions with the United States escalate again and the exchange rate is used as a weapon, there is a possibility of depreciation. So, will the contradictions between China and the United States continue to escalate or tend to reach an agreement in the future? To be honest, it is still unclear at present because there are too many variables. In the first round in 2018, it took both sides 20 months to finally reach an agreement, which is already considered relatively fast. However, if an agreement can be reached, China is highly likely to increase its purchases of US agricultural products and energy. China's tariffs on US goods may return to the previous level or be slightly reduced, and the US tariffs on China will also be significantly reduced. But whether it can return to the era of Biden remains to be seen. The exchange rate of the RMB will definitely be stronger than it is now and may return to around 7, and there may still be some fluctuations during the negotiation process. In the long run, for China to develop stably, it can only continue to implement the previously determined domestic demand policies. The United States has a population of 335 million, accounting for 4% of the world's population, but its consumer market accounts for 34.9% of the global market. China has a population of 1.4 billion, but its consumption only accounts for about 15% of the world's total. If China can increase its consumption to around 1/3 of the global total, it will no longer be as passive as it is now. The above chart shows the proportion of domestic residents' disposable income in GDP over the past 40 years. It can be seen that the overall trend is downward. At this stage, it is necessary to increase the consumption capacity of the people and activate the domestic market. This can optimize the economic structure, reduce the intense competition in employment, relieve the living pressure on the people, and also ease the contradictions with major trading partners, which is conducive to conducting long-term business.